Good evening, Nick Inman from VolumeProfileTrader.com on Thursday, July 5th, and the S&P pretty much banging up against the top of this high volume area. We're seeing a little bit of selling pressure, which you should expect into a jobs number tomorrow, and after a multi-day rally. So, expect the expected and kind of go from there. Now, I still believe that the potential for higher prices is very possible. We could easily go retest the 1400 level, which really isn't that far away. But given where we are right now, the top of this high volume area, and after the 29th, after the EU announced their plans, and we had that big gap up and continuation, I would expect the market to pull back some. I could be totally wrong, but that's what I'm expecting. That's what I'm positioned for. And I'm still looking at this breakout that we saw, though on light volume, well, relatively light. We did have some pretty good volume days at the beginning of July. But since then, and considering this week's a light volume week, expect the expected, and that's pretty much what we've got. We had one solid up day since that big, that 629 move. Since then, we flatlined, and the best way to approach this market is to stick with what is working. So let me give you a few examples. Not Atlas Pipeline, but Apple. Now this continues to move higher. They have earnings in about 20 days, and they're making a little pre-earnings run. That's what's going on right here, right now. What I'm going to do on Apple is zoom it down to a year-to-date chart, and you can see the point of control. Let's focus on 575 down to 566, and we're breaking out from those levels. So actually today, I've been long since, really right in the middle of those levels. And it's been paying off greatly the past 4 days. But I'm not going to get greedy. I realize that this is the top of a high volume area. This could be potential resistance. Looking at it on an intraday chart, point of control for looks like, let's see, June, May, April. We pierced above that high volume. Basically, got to these swing highs, between the swing highs and the top of this high volume area, and we failed from there. I scaled out of some of my Apple just above 609. It ran a couple more dollars, and then that's all she wrote for right now. I would expect some type of pullback on Apple. I'm not saying that this is the end of it, but I'm expecting some type of pullback. With the rest of my shares, I'm using this trailing stop as my indicator to scale out of more. So I'm always going to be staying involved in Apple. I always want a base position, which isn't that big relative to a full-size position, but I want to stay involved. And we've had a nice little run going into the jobs number. I want to alleviate some of my long positions. So I look at something like Apple, I take some profits. Look at something like Caterpillar. I recommended this back at the lows, the day of the lows. Let me show you. 9 o'clock is when, or I should say when the market opened. That's when I noticed this, and that's when I sent an email out saying, put Caterpillar on your radar. The reason why? Not because of this chart, but because of this chart. Value area low for the year. We get a bounce, and now we're seeing some follow through. For now, this has been a short-term trade. It's worked out nice, but you don't want to overstay your welcome. We are at the value area high for June, and now we're getting a little bit of a U-turn off of those levels. Caterpillar is another name that I scaled down on. From long under 82 to a move up to 87 in a couple of days, that's a pretty good move, and you don't want to overstay your welcome, given that where the market's at. Remember, S&P, top of a high volume area. There you go. S&P, top of the high volume area, so you could expect some type of pullback. Let's go to Bank of America. This is something I'm actually, and I hold my breath when I say this, I'm short. And I got short back on, let's see what day it was, the 2nd. And I know on the 29th, when we had that big up day, I was raving about the banks, saying they look ready to break out, and they did. And I'm not even saying that they still don't, but just not right here, right now. We've had 3 days of light volume, which you can expect given what week it is. But also, you need to keep in mind value area high for the year, point of control for the year, and it's really a pretty easy sale. And the trade's pretty nice in the green, not that big of a winner. Just above $8 is my cost basis, but it's working, and my hope is that I can get it. Well, if it got down to $7.20 or so, $7.25, that would be great. But I'm not really looking for that. I'm looking for a pullback back down to the last month's high volume area, which is between 766 and 751. The point of control for last month is, let's go with 758. So that's kind of your target. You're looking for Bank of America to get down to those levels and look for a bounce. If we don't get that and the jobs report tomorrow is strong enough to reverse this and push it back up, then you need to be aware of that. But considering we have some gaps, even down here, we have a gap. There should be some downside momentum on Bank of America. All right, oil. Okay, oil rejected. It pierced it today, but it's at these contract highs, and we're at the value area low from last week. Last 2 months ago. The top of this high volume area here, which goes back for the year. Basically looking for a little pullback on oil back down below 85. Basically looking at last month's high volume area. We'll stick with this. Between, call it 83.25 and 85. Looking for a pullback down to those levels. I do have some USO, which is that is the ETF for oil, and it has the issue with being related to oil futures, and when oil futures roll over to the next month, USO sells off, or it just doesn't have the same effect. So basically looking for a pullback on USO. The puts I bought, I want to say they're either the 32 strike that expire in 15 days or so. So I'm looking for a move fairly quickly. I'm basically using tomorrow's jobs number as a catalyst, and we'll see. But these positions are to hedge against some of my longs that I'm holding. Some other names, let's see. If we get a pullback in the market, which I expect we do, look at something like Monsanto, $84, new 52-week highs. A pullback down towards 80, the point of control for the year, should be bought. when you get a pullback and then a bounce off of Monsanto, I think that's your opportunity to increase your position on Monsanto or start a new one. Just throwing that out there. So really, the last position I really have that I don't mind talking about is I'm short SPY, and you may wonder why, but it's for a hedge. I need to be, as a risk manager, I need to be market neutral going into the jobs number. If it's, let's say the jobs number is out of the park, 200,000 jobs or more, well then the market will probably rally and you will see a lot of shorts cover. But what if the jobs number is disappointing? You're going to get a sell-off, and you're going to see lower prices on the S&P, on the broad market, probably by 1% or so. And you need to be protected and take advantage, at least to cover your butt some, so you're not licking your wounds with a portfolio full of longs. So let me show you the monthly chart of the S&P really quick. Okay, this is what I'm looking at. This high volume area here at 1370, basically the current highs, down to about 1360, where price is currently traded. That's what I'm protecting myself from. If we sell off from those levels and start retracing back down towards last month's high volume area, even if it's down to 1330, the top of this one, even if it's down to basically the value area, and it's going to come down here. It's not. I highly doubt that the market just keeps going higher. But even if it retraces another 10 points, it's better to be protected on an obvious pullback than just letting your longs get hit. And that will keep you, one, it will keep your portfolio near all-time highs. And two, you're putting yourself in a position where if this is a bigger sell-off and your longs get stopped out, your short positions all of a sudden are in profitable positions, and you can just trail them. And if they hit your target and you want to take the position off, that's fine. But you're basically, by having your stops and by, being okay with being on both sides of the market, you are putting yourself in a position to not care what direction the market goes. Rather, you're managing risk by using, trailing stops and high volume areas, good solid support resistance to trade off of. And I promise you'll see your portfolio continue to hit all-time highs month after month. So anyways, that's really it. Take care, have a good night, and I'll talk to you this weekend.